You want to invest like Warren Buffett? Well, here's one of the stocks he owns. Big time. Hey up everyone, welcome to Martyn Lucas Investor. I'm Vas and we are covering Occidental Petroleum, just as you can see above me, third quarter 2025 earnings call and their results. Well, mainly their earnings call because the results they released last night. This is one of the companies they released their results one day and report on them the following day, which I don't mind because we could bring you very interesting stock and very interesting earnings call last night as well. It was Gevo who develop alternative fuel for aircraft. They develop carbon capture technologies and all sustainable energy as well. And they are apparently making quite good money on it as well for a startup. So that was just quick review from yesterday, and today we are covering Occidental Petroleum. The results, the numbers went out last night. You can see there wasn't much of a massive reaction on the night. However, in the morning, look at this, market open and we went all the way over 5% up compared to the previous closing bell. Currently, we are stagnated around $42.66 and $42.70. This is looking fairly promising. Let's wait for the guidance. The actual earnings call starts in about 10 minutes. So stand by. I've got quick show notes. I will explain what Occidental Petroleum, also known under the ticker symbol OXY, OXY, what they do. I'll go through it quickly so you are put into context of what's going on. Let's just quickly go through the markets. S&P today flat, Nasdaq slightly down. There was a retraction. At one point it was 1% down. Bitcoin down, XRP down, Ethereum down. Not a good day for a crypto investor. Gold pretty much steady but slightly down, and silver above $50 per ounce. So that is a good position. I mean, gold $113 over the $4,000 mark is fairly good, I think, considering the recent spike and the development of the price. I think it's fairly good. So Occidental Petroleum, Warren Buffett should be watching. He should be watching and she should be taking the notes. I'm pretty sure he would find this very useful. So Occidental Petroleum, what do they do? So Occidental Petroleum is a United States-based multinational energy company. They operate in oil and gas exploration, production and carbon management. They own OxyChem, which is chemical arm production, PVC, plastic, caustic soda, and other industrial materials. Strong focus on carbon capture and enhanced oil recovery using CO2 injection, particularly in the Permian Basin. What is their product? Well, first of all, we need to mention upstream exploration and production of crude oil, natural gas liquids, and natural gas. Also, chemicals, OxyChem, the subdivision OxyChem. They manufacture PVC, polyvinyl chloride, basically plastic, chlorine and caustic soda for water, building and energy industries. Midstream and marketing. They handle gathering, transportation, storage and marketing of hydrocarbons as well. And carbon management, very important part as well. They develop and invest in direct air capture and carbon storage facilities. So we are green as well. We are not only producing product that which we use, the byproduct of it is CO2. We are also trying to capture it and make up for it. That's good. Market position and PS. We are about 8 minutes away from the earnings call. So let's quickly flash through this so you are put into context of what we are going to talk about. Market position and PS. Among the largest independent oil and gas producers in the United States. Major footprint in the Permian Basin, plus operations in the Middle East and North Africa. Diversified portfolio provides balance between traditional hydrocarbons and emerging carbon capture. Great. Main peers: Chevron, ExxonMobil, Shell, and ConocoPhillips. So basically the big oil names, the big oil animals. Competitive strength: vertical integration, chemical diversification, and leadership in carbon management technologies. Now, why is this company interesting? Well, Warren Buffett wasn't holding back when he invested in Oxy. Berkshire Hathaway, led by Warren Buffett, owns roughly 28% of Occidental Petroleum's outstanding shares, which is over 250 million shares. Buffett's stake began in 2019 when Berkshire provided $10 billion in financing for Oxy's Anadarko Petroleum acquisition, earning 8% preferred dividends and warrants for 83.9 million shares at 59.62 cents each. Since then, Berkshire have repeatedly increased its common stock position, showing long-term confidence in Oxy's cash flow generation and energy transition strategy. Buffett has stated he does not plan to take full control, but views Oxy as a core US energy holding, and this is very important, citing its management, Permian dominance, and strong returns on capital. The Berkshire presence significantly boosts investor credibility and stability, often cushioning Oxy's downside and drawing attention from institutional investors. Numbers, just to put in context today's numbers. The numbers are already out. Don't go anywhere. The actual webcast is about 5 minutes away. Let me quickly check this. I've got it on standby. As you can see, you can't hear it because they are playing music in the background. I cannot play the music for copyright reasons, but I'm monitoring it. As soon as they start talking, I will zip it and I will let you listen to this interesting company's report. Last quarter, to put this into context, oil and gas pre-tax income almost $1 billion. We had $934 million. A realized crude oil price 63.73 per barrel. Production 1.4 million barrels per day. Chemical income 213 million, midstream and marketing income 49 million, operating cash flow 2.6 billion, and free cash flow of 700 million. Revenue 6.49 billion. Earnings per share beat estimates. Revenue fell year on year amid weaker commodity prices. What were the expectations? What were the predictions? What was the consensus for this quarter? Well, we're gonna find out the numbers. I'll go through them very shortly. Let's just put this into context. Third quarter 25 predictions. That's coming from last night before the numbers came out. A revenue forecast expected at 6.7 billion. Earnings per share positive 48 to 51 cents per share. Production guidance 1 billion 415 to 1 billion 455 million of barrels per day. Oil and gas revenue slight decline year over year expected, and chemical segment revenue around 1.2 billion, which is slight decline of 4% year over year. Main focus is on debt reduction, cost control, and stable cash flow amidst commodity volatility. So here are some key takeaways and key notes for the actual earnings call, so you can read through it quickly. I'm just quickly refreshing the webcast that's on standby. We are about 2 minutes away. Let me go quickly to you in the chat. I see we've got some good engagement. Thank you very much. I would like to ask you, we are running a poll. Are you invested in Occidental Petroleum? long-term invested, trading, not investing, and never heard of them. If you've never heard of them, you are in the right place, because I just gave you a quick update, quick breakdown, and in a minute or couple of minutes, you're gonna hear from the company, from the CEO and from the directors, and you will get better explanation of what they actually do. So who we've got here? Let's have a look at the chat. Jim is here, who requested this earnings call. Good morning, Vaz. I will be here, just working, so might not respond, but I'll be listening. That's no drama, Jim. I'm glad I could bring you this. This is one of the members perks. You need to be a member to request an earnings call, but this quarter has been very, very manic. I don't know how it happens, but all the sector peers, they always report on the same day or on the 2 consecutive days. We had 5 of the Mag 7 companies reporting within 2 days. It was just crazy. We couldn't cover everything, but we are always trying to prioritize our members. Yestin is asking, what's the news with vertical? What's going on with my chat? I can't scroll up. What's going on with my chat window? Hang on. Okay, let's do it. What? Hang on. Let me refresh this. I'm having some mess up with YouTube. I don't know what's going on. Okay, let's pause this. Put this on the screen. What is going on? Right, they are starting the webcast, so I will leave this on the screen. I will come to you shortly on your question about vertical aerospace. Let's just tune in and listen.
After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star then 1 on your touchtone phone, and to withdraw your question, please press star then 2. Please note that today's event is being recorded. I would now like to turn the conference over to Jordan Tanner, Vice President of Investor Relations. Please go ahead.
Thank you, Rocco. Good afternoon, everyone, and thank you for participating in Occidental's third quarter 2025 earnings conference call. On the call with us today are Vicki Hollub, President and Chief Executive Officer.
I will reply to your
Matthews,
chat questions
Senior Vice
in the
President
chat.
and Chief Financial Officer. Richard Jackson, Senior Vice President and Chief Operating Officer. And Ken Dillon, Senior Vice President and President, International Oil and Gas Operations. This afternoon, we will refer to slides available on the Investors section of our website. The presentation includes a cautionary statement on slide 2 regarding forward-looking statements that will be made on the call this afternoon. We'll also reference a few non-GAAP financial measures today. Reconciliations to the nearest corresponding GAAP measure can be found in the schedules to our earnings release and on our website. I'll now turn the call over to Vicki.
Thank you, Jordan, and good afternoon, everyone. I want to take a moment to recognize Veterans Day and express our deep gratitude to all veterans and their families for their service. Today, I will address our recently announced sale of OxyChem, outline the strategic rationale, and highlight our third quarter performance. Richard will provide details on our oil and gas operations, and Sunil will review our third quarter financials, fourth quarter guidance, and considerations for the year ahead. The sale of OxyChem is a pivotal step in our transformation. The decision was driven by the scale, quality, and diversity of the oil and gas portfolio we have built over the last decade. Since 2015, we have more than doubled our total resource potential and our production, going from total resource of 8 billion barrels of oil equivalent to 16.5 billion barrels of oil equivalent, and from production of 650,000 BOE per day to over 1.4 million BOE per day. We now have a higher quality portfolio with Oxy's lowest ever geopolitical risk, as we have shifted the percentage of our oil and gas production from 50% domestic to 83% domestic. And our portfolio has a development runway of 30 plus years that includes high return, short cycle, higher decline, unconventional assets, complemented by solid return, lower decline, mid-cycle development opportunities in our conventional oil and gas assets. Our substantial oil and gas runway, along with our demonstrated expertise in maximizing resource recovery, created the foundation for accelerating value to our shareholders through the divestiture of OxyChem. The proceeds will be used to immediately strengthen our balance sheet, allowing us to significantly deleverage and achieve our principal debt target of less than $15 billion. This will reinforce our financial resilience and agility to navigate changing market conditions. With greater financial flexibility, we can broaden our return of capital program and accelerate shareholder returns. This will enhance our approach to delivering value to our shareholders by increasing cash returns and continuing to rebalance enterprise value through net debt reduction. Our strengthened financial foundation will enable us to accelerate the development of our industry-leading oil and gas portfolio by focusing capital on our Permian unconventional assets, including unconventional CO2 floods, along with our Gulf of America water floods, and in the future, our Bakia gas and condensate discovery in Oman. We're excited about all the opportunities ahead to apply our subsurface expertise for greater resource recovery and the opportunities to advance our various low-decline enhanced oil recovery projects, particularly our CO2 EOR projects. Now turning to the third quarter, our teams delivered another strong quarter of operational performance, generating $3.2 billion in operating cash flow and $1.5 billion in free cash flow before working capital. Notably, we exceeded last year's third quarter operating cash flow despite WTI prices that were more than $10 per barrel lower in the third quarter of this year. Our team's continued focus on cost management and efficiency improvements also led to our lowest quarterly lease operating expense per barrel across our full oil and gas segment since 2021. This ongoing improvement in portfolio and operational performance underscores the quality of our resources and the exceptional caliber of our teams, who continue to bring forward value by delivering more with less. In the third quarter, our oil and gas business produced approximately 1.47 million barrels of oil equivalent per day, exceeding the high end of our guidance range. The Permian Basin contributed 800,000 BOE per day, which is the highest quarterly Permian production in Oxy's history. The Rockies also posted outstanding results thanks to strong new well performance and stable base operations. Additionally, our Gulf of America assets outperformed the high end of guidance, benefiting from favorable weather and achieving the highest uptime in our operating history. Our midstream and marketing segment delivered another incredible quarter, generating positive adjusted earnings and surpassing the high end of guidance. Our teams expertly navigated market volatility to maximize margins through strategic gas marketing, helping to offset challenging gas price realizations. Higher sulfur prices in Al Hosn further contributed to the quarter's results. As shown in our third quarter results, we remain focused on generating free cash flow at lower oil prices and maintaining flexibility in our capital and development programs to support near and long-term value creation. Richard will now provide more details on our third quarter operational highlights and how we are positioned to generate stronger returns and higher free cash flow.
Thank you, Vicki. I appreciate the opportunity to share the progress we are making in our operations and how we are positioning our plans going into 2026. In all parts of our oil and gas business, we are making significant advancements through a focus on three key areas: resource improvement, cost efficiency, and operating ability to generate free cash flow across a range of oil price scenarios. Today, I will focus on our Permian operations, where there have been several meaningful updates across these three areas. I look forward to sharing more from our other teams in future calls. First, let me begin by highlighting our strong third quarter results. As Vicki noted, domestic production exceeded guidance with strong contributions from all business units in the Permian, Rockies, and Gulf of America. This strong performance and record results were achieved while sustaining our outlook for lower capital and improved operating costs for the year. Compared to our original 2025 guidance, we have reduced capital expenditures by $300 million and operating costs by $170 million. We appreciate our team's continued efforts to exceed expectations. Importantly, this performance is part of our continued track record of cost efficiency. We recently highlighted that since 2023, we have realized $2 billion in annualized cost savings across our U.S. onshore operations, driven by continuous operational improvements in drilling, completions, and operating expense categories, as well as a value-focused supply chain management approach. We are seeing similar improvements across all of our operating teams and look forward to these efficiencies continuing into 2026. Building more on Vicki's introductory comments, we have made important progress in our organic oil and gas resource improvement across the portfolio. Today, I will focus on the Permian as it plays an essential role in our near and long-term results. We have recently expanded our Permian resource base by 2.5 billion BOE, which now represents approximately 70% of Oxy's total resources of approximately 16.5 billion BOE. We achieved this organic resource expansion through subsurface characterization and the application of advanced recovery and technologies. Our deep Permian resource is both low cost and provides operational flexibility to support free cash flow across a wide range of oil price scenarios. When combined with our ongoing cost efficiencies and technical recovery advancement, this places the Permian as a core value driver for Oxy's future. To start, in the Delaware Basin, we continue to be a leader in new well performance across both our primary and secondary benches. Importantly, our secondary bench wells outperform the industry average by 10% when compared to all benches, primary and secondary in the basin. In addition to improving productivity, these secondary benches also enable us to efficiently utilize existing infrastructure that was built to support our primary development. As a result, we have extended our resources through increased secondary bench development while lowering our overall development costs, leading to a 16% lower capital intensity since 2022. Additionally, over the last few years, we have significantly transformed our position and performance in the Midland Basin. Today, these development projects are incredibly competitive in our Oxy portfolio. This process began with a basin-wide subsurface characterization initiative and targeted development program to more fully understand the resource potential in the basin. We then strengthened our acreage position and achieved the scale needed for operational efficiencies through the Crown Rock acquisition. Today, the combined Oxy and legacy Crown Rock teams are delivering industry-leading well costs and performance, driven by both continued operational improvements and refined subsurface designs. Since 2023, our new wells have shown a 22% increase in 6-month cumulative oil production per 1,000 feet, while the industry average has declined about 5% over the same period. We have also reduced well costs by 38% since 2023. These step changes have created an expanded deep bench opportunity, allowing us to organically add top-tier Barnett resources across 115,000 acres in our Midland and Central Basin platform operating areas. Again, we highlight that our new well performance in the Barnett is outperforming the industry average by 18% since 2020. Another resource opportunity and key differentiator for Oxy is the expansion of enhanced oil recovery into our unconventional shale. As a leader in conventional CO2 EOR, we are leveraging our decades-long investment and expertise into these assets. Since 2017, we have advanced unconventional EOR in our U.S. Permian and Rockies business units, completing multiple demonstrations where we have achieved positive and consistent results. These projects have delivered over 45% oil uplift, but we believe with continued optimization, our commercial projects have the capability to deliver up to 100% production uplift. We're now moving into commercial development with 3 initial projects and a current pipeline of 30 more ready for development. These mid-cycle projects offer low decline rates and competitive returns. Our unique and sizable Permian Basin CO2 infrastructure gives us an advantage as we scale these developments over time. Today, this represents a resource opportunity of over 2 billion BOE. We also continue to advance our existing conventional EOR assets. With approximately 2 billion BOEs of undeveloped resources with low development costs, these mid-cycle projects are also meaningful as part of our future resources. Recent improvements in cost structure, including $80 million of our 2025 domestic operating cost reductions, continue to improve the returns and investment priority within our portfolio. Beyond CO2 EOR, we are progressing a suite of complementary recovery technologies, including infill drilling, precision well placement and spacing, next-generation frac, and other methods of EOR. We believe our ability to organically expand our low-cost resource base through subsurface characterization, continued cost efficiency, and advanced recovery technologies give us a competitive advantage to deliver long-term value. As we look ahead to 2026, we continue to actively manage our operational scenarios for a disciplined approach for resilient free cash flow, even if in challenging oil price environments. Our approach begins with a focus on operational and cost efficiency over activity reductions to preserve future free cash flow and to maintain optimized activity across our assets. A key part of this approach is working closely with our service company partners to capture supply chain savings, improving value for both parties. Beyond that, we selectively defer multi-year facilities and construction projects, allowing us to invest opportunistically in these projects when conditions are more favorable. We also regularly review and optimize our operating expense activities to enable us to scale and time activities for maximum free cash flow. Finally, we evaluate capital and development activity adjustments, always with a focus on achieving the most efficient capital to cash flow outcome. At much lower oil prices, capital flexibility becomes critical, and we remain committed to investing wisely, preserving optionality, and delivering value through efficient execution. As we enter 2026, we're targeting a $55 to $60 WTI plan with flexibility to adapt to market conditions while continuing to improve cost efficiency to deliver our free cash flow needs without impacting operational performance. Looking ahead, we have a deep portfolio of short-cycle, high-return, and mid-cycle low-decline assets that can deliver strong cash flow. We are focused on sustaining momentum by driving cost efficiency, advancing recovery technologies, and optimizing our operations. Lastly, I'd like to thank all of our teams for their continued performance and especially safety as we look to end the year strong. I'll also look forward to working closer with many of you for the first time or again in my new role. Thank you for your time today, and I'll now turn the call over to Sunil for the financial discussion.
Thank you, Richard. In the third quarter, we generated a reported profit of 65 cents per diluted share. Strong operational performance and a continued focus on capital efficiency enabled us to generate approximately $1.5 billion in free cash flow before working capital. We had a negative working capital change, primarily driven by the timing of semi-annual interest payments on our debt and payments within our oil and gas segment. During the quarter, we repaid $1.3 billion of debt, bringing our total year-to-date debt repayment to $3.6 billion and reducing Occidental's principal debt balance to $20.8 billion. A strong financial performance can largely be attributed to higher volumes across our U.S. portfolio, which more than offset slightly lower than expected production from our international assets. New well and base production outperformance in the Permian and Rockies, as well as higher uptime and favorable weather in the Gulf of America, enabled us to exceed the high end of guidance across all of our domestic oil and gas assets. This production outperformance and a continued focus on delivering operational cost efficiencies led to lower domestic lease operating expenses in the quarter, notably outperforming guidance at $8.11 per BOE. Part of the outperformance also reflected the timing of certain offshore production engineering activities, which shifted into the fourth quarter. In the midstream and marketing segment, we continued to capture value through optimizing our gas marketing positions out of the Permian Basin and higher sulfur pricing in Al Hosn. Both were significant catalysts in the segment, generating positive earnings on an adjusted basis of $153 million, above the midpoint of guidance. Looking ahead, we are increasing our full-year guidance for our oil and gas and midstream and marketing segments as a result of our strong third-quarter outperformance and improved expectations for the fourth quarter. In oil and gas, we are raising our fourth-quarter total company production guidance from last quarter's implied guidance to a midpoint of 1.46 million BOE per day. This is driven by the expectation for continued strong performance across all three domestic assets, which should more than offset impacts from a scheduled turnaround at Al Hosn in the fourth quarter. Other midstream and marketing pre-tax income guidance assumes that our teams will capture gas marketing optimization benefits from the wider Permian to Gulf Coast spread observed already in the fourth quarter. We expect full-year pre-tax income from the segment to come in approximately $400 million above our original guidance, largely due to those gas marketing opportunities and stronger than anticipated sulfur pricing from Al Hosn. Due to continued softness in the global chlorovinyl market, our third quarter OxyChem pre-tax income came in below guidance at $197 million. We are guiding to $140 million for the next full quarter. Beginning in the fourth quarter, OxyChem will be classified as discontinued operations. We are in the process of evaluating the potential impact of OxyChem's classification on our fourth quarter adjusted effective tax rate, and we will provide a further update early next year. Total company capital spend, net of non-controlling interest of approximately $1.7 billion, was in line with our expectations for the third quarter, and we expect to remain within our previously guided range for 2025 capital. As Vicki shared, the OxyChem transaction marks a significant milestone for our company, as it will strengthen our financial position and enhance our ability to return capital to our shareholders. The all-cash nature of this transaction will enable us to accelerate our debt reduction efforts and achieve our post-Crown Rock principal debt target of less than $15 billion. Of the roughly $8 billion in transaction net proceeds, we plan to use approximately $6.5 billion to reduce debt. Our initial focus is on the $4 billion of debt maturing in the next 3 years. This includes $1.3 billion of term loans maturing in 2026, which we can call at par, and for the remaining $2.7 billion, we may largely use make-whole provisions to ensure certainty. Beyond that, we will be opportunistic, taking into consideration redemption prices and the impact on our maturity profile. This will meaningfully improve our credit metrics and is expected to lower our annual interest expense by more than $350 million, while providing a very manageable near-term debt maturity schedule. The remaining $1.5 billion in net proceeds will go to cash on the balance sheet. By significantly lowering our debt burden and building cash on hand, we will create a stronger, more resilient balance sheet. With the achievement of our post-Crown Rock principal debt target, Oxy will be positioned to broaden our return of capital program and adopt a more flexible framework for delivering value to our shareholders. We will be opportunistic with the share repurchase program. Our decisions and priorities will be driven by a range of factors, including the macro conditions, commodity prices, market valuation relative to Oxy's intrinsic value, cash on the balance sheet, and the timeline to August 2029. We plan to resume the redemption of the preferred in August 2029, when the preferred equity becomes callable with a lower redemption premium and does not have the $4 per share return of capital trigger. Now I would like to share how we are approaching our capital program for 2026. Last quarter, we discussed the potential to allocate capital to mid-cycle conventional oil assets. We are planning to increase investment in the Gulf of America waterflood projects and in Oman, given both projects' high oil weighting and favorable base decline rates, combined with the enhanced economics in Oman following our Mukhaizna contract extension. Approximately an additional $250 million could be allocated to these areas as capital rolls off in our LCV portfolio. Considering the recent commodity price volatility and oil market outlook, we are evaluating multiple capital scenarios across our U.S. onshore portfolio. With the OxyChem sale, our U.S. onshore capital will comprise an even greater proportion of the total company investment program, which provides flexibility should the macro environment deteriorate. As Richard mentioned, we have an incredible runway of high-quality oil and gas opportunities and sustained momentum in delivering value through greater capital efficiency. We plan to reallocate up to $400 million to these short-cycle, high-return projects, primarily in the Permian. Any additional allocation of capital next year will be undertaken in a thoughtful manner with an eye to the oil market given oversupply concerns. The quantum of that reallocation will depend on the macroeconomic environment, and we plan to share more on our 2026 capital budget during our fourth quarter call pending board approval. I will now turn the call over to Vicki for closing remarks.
Thank you, Sunil. As we highlighted, the OxyChem sale represents more than just a business decision. It marks the final major milestone in the strategic transformation that we've been pursuing for years. With this step, we're accelerating opportunities to extend our advantaged, low-cost resource position and leveraging integrated technologies to deliver differentiated recovery and superior value. We are confident that these actions will further strengthen our competitive position. With that, we'll now open the call for questions. And as Jordan mentioned, Ken Dillon is joining us today for the Q&A session.
Thank you. We will now begin the question and answer session. To ask a question, you may press star then one on your touchtone phone. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star.
Needless to say, this is the most important and interesting part of the whole earnings call, so don't go anywhere. We're going to find out a lot of news. Yesterday's was brilliant. On Jivo, it was a great Q&A session, so let's stand by.
And today's first question comes from Doug Leggate with Wolfe Research. Please go ahead.
Thank you. Good afternoon, I think it is. Good afternoon. I'm in New York. I was trying to figure out what time zone I was in. Vicki, maybe the first question is for Sunil, actually, is on the capital guidance that you just talked about there, the soft outlook. If I'm doing the math correctly, so you dropped about $300 million, from the beginning of this year, so you're 7.2. But 900 was chemicals, as I understand it, for next year, and I believe this year was 450 on DAC. So that's about 1.35. I'm trying to kind of get to the range for next year. So if you add back the 650 you talked about, are we in the ballpark to think that spending next year should be down about $700 million based on your remarks, Sunil?
Yeah, so Doug, you're right on the way you're approaching it. Like you said, midpoint for CapEx guidance for this year, $7.2 billion. Chemicals is $900, so you back out that, you're at $6.3 billion. Like I mentioned, we are going to increase CapEx in the Gulf of America waterfront projects and Oman, which is around $250 million, which will be largely offset by the roll-off of capital in our low-carbon venture portfolio. So you're back to the $6.3 billion. And with respect to U.S. onshore, like I mentioned in my prepared remarks, we are looking at potentially investing up to $400 million. So you start with 6.3, and it could be somewhere between 6.3 to 6.7 billion, depending on the macro environment. And the other thing I would highlight is, like I said, with this increased spending in U.S. onshore, a proportion of U.S. onshore CapEx as a percentage of the total CapEx will increase. What that means is a lot more flexibility if the macro is going to become more unfavorable. And so that is one important thing. And I think, like Richard said in his prepared remarks, the way we think about capital allocation for U.S. onshore, if we were to adjust our capital program, first we look at our efficiency, both operating efficiency and what we're seeing in the market. Second is potentially how we can defer some of our facility spending. And the last thing would be in terms of activity. So I think from a capital point of view, you're looking at somewhere between 6.3 to 6.7 billion, with a larger proportion of U.S. onshore CapEx, where we have a lot more flexibility.
The street's obviously very smart, Sunil, because it's sitting at 6.5 right now. So that's really helpful. Thank you for that. My follow-up, if I may, is for Richard. I'll take advantage and also wish him congratulations for your new role, Richard. I'm thinking a Permian field trip might be in the offing, but we'll take that one offline. My question is, you did say you've added 2.5 billion barrels of resource, mostly in the Permian. You've obviously got, it looks like, sector-leading drilling per lateral foot cost now, and clearly the break-evens in the Barnett the Barnett are coming down. So my question is, you haven't given us a drilling backlog or a break-even for the sustaining capital for the portfolio. So I wonder if you could address those. Where does this leave your drilling inventory, and what would you say is the sustaining capital break-even at this point for the portfolio?
Hey, Doug, this is Richard. Great to hear from you, and appreciate that for sure. Always enjoy our Permian visits. Let me start just sort of addressing generally why resources. I think, for a long time, we've been trying to characterize our strong unconventional resource base, and the way to do that was to talk about drilling inventory and think about break-evens against that. I think as we look forward, as we're explaining today, we're so much more than that. We have our big opportunities in our conventional assets, and just felt like moving to more of a resource explanation was a better representation of what we are and the value that we have. If we sort of break down that 2.5 billion barrel Permian add, much of that is coming from continued unconventional shale improvements. And in our view, this is technology. This is using our subsurface characterization to continue to fine-tune our design, especially around the secondary benches, which we felt like was important to point out in this highlight. It includes things like the Barnett, where we had an existing position. Much of that Barnett resource runs into our Central Basin Platform, where we've operated in our enhanced oil recovery business unit for a long time. And so, much of that continues, and that would be a direct translation to the drilling inventory that we've disclosed previously. But the other piece is the EOR, and we highlight the unconventional EOR today, but also across our conventional position. And so in total, we just felt like that was the right way to think about it. In terms of the Barnett, obviously a big piece of that, becoming competitive in our portfolio is the drilling cost improvement, and just very pleased with the progress by the teams in the Midland Basin for what they've been able to do. But we're seeing that across all of our basins. I think we highlight in one of the slides about a 14% total reduction in well cost across all of our unconventional drilling. Same in the Rockies. So in general, that's improving our resource base. And so I think going forward to the break even, we'll continue to characterize that resource base with a break even. I think we've talked about our projects for the year, our annual program, are all less than $40 break even. And so on a project basis, that we expect that to continue. And like we've shown in the past, it's always improving the resource. Expanding it, yes, but improving is the most important component of it, and cost is a big part of that.
Thank you. And our next question today comes from Arun Jayaram with J.P. Morgan. Please go ahead.
Yeah, good afternoon. My first question is maybe on slide 16, perhaps for Richard. I was wondering if you could maybe give us more details on the demonstration pilot. Looks like in this example, you're highlighting, CO2 injection around 3 years after, initial production from the well. But I was wondering if you could just talk about the applicability of this on older wells that may have been completed, 6-7 years ago, and maybe just a little bit about the math around the 2 billion BOE resource opportunity. That'd be helpful.
I have put up a new poll in the chat.
Appreciate that,
listening to the call. Is it a buy, hold, sell, or undecided? Let me know.
In the Midland Basin, it was with CO2. these wells were originally online in about mid-2015. So your question's perfect. While they apply to historic wells like we're showing here, they also apply to more recent vintage as well. And I'll walk through that math in a second. But just a little bit on that pilot. Again, that's about a 45% uplift. We had 5 injection cycles that were completed over those 3 years. We stopped and saw this 45% uplift. If we modeled out continued cycles of CO2 injection, this is where we get to the 60 and even 100% production uplift. And so that, that's where that comes from. If we look at the 2 billion barrel, if you think about, recovery factors in the, 8 to 12% with unconventional, if you look at this 45 to 100% uplift, now you're talking about reaching recovery factors in the 15 to 20%. So that, is likely a little bit more for the oil and perhaps a little bit less for the gas in an oil reservoir. But if you look across, the de-risked unconventional acreage where we have this opportunity, that's how we begin to account for the 2 billion barrels of unconventional EOR. As I mentioned, and we've got 3 projects that will be working into commercial development over the next couple of years. Those are really spread between New Mexico, Texas, Delaware, and the Midland Basin. So again, it's sort of an approach that can be applied to multiple areas. And then, based on this technical work, we have another 30 development-ready projects across these basins that will be ready to develop. And so, again, as we think about the role of mid-cycle, low-decline cash flow in our outlook, we believe these can be very meaningful as we look forward into future years.
Great, that's helpful. My follow-up is Sunil mentioned that you could redirect $250 million of capital from the reduction in LCV capital back into the Gulf of America for water floods in Oman. I was wondering if you could provide some thoughts on what you believe these water flood projects can do to your productive capacity in the Gulf of America. Maybe just thoughts on Gulf output as we think about 2026.
Hi, good afternoon. We now have 2 water flood projects FID'd in Goa. These will result in improved recoveries of nearly 150 million BOE and significant reductions in decline rates over time. Potentially, these could lead to Goa declines going from 20% today to 10% in 2030 and 7% by 2035. So a significant impact on the base. First up is at the King Field, which is a tieback to Marlin. There will be a dump flood, which requires very limited facilities. That will be on stream in Q2 next year. This will lead to a potential extension in field life of around 10 years. At Horn Mountain, we've used the latest OBN seismic with our in-house developed tools to place the first injectors. 2 will be drilled in Q1 2027, and in parallel, facilities will be installed in Horn Mountain, leading to a target injection date of Q2 2027 and an expected response date during late summer 2027. We've been ready to go for some time, and all the long lead items have now been placed. Returns expected to be in the 40 to 50% range for these projects. So overall, last time I talked about improving well performance, this time talking about lower decline. And as you can see, we've had improved reliability both on rotating equipment and general facilities. We were aided by weather a bit, including, I would say, being able to get through a lot of fabric maintenance work in this time period. So overall, still working on next year's plan. Part of that is tying the construction activities for the water floods to the planned maintenance required offshore so that we only take the platforms down once and don't have multiple staggered turnarounds.
Thank you. And our next question today comes from Neil Mehta with Goldman Sachs. Please go ahead.
Yeah, good morning, Vicki.
Archer Aviation up 10% on the day.
Time for Stratos as you guys are ramping this project up. And so as the rubber hits the road, just wanted to understand what the gating items are and early thoughts around startup activities.
Good afternoon. Yeah, overall, the Stratos Phase 1 startup is proceeding well. Since we last talked, we've commissioned the central processing unit with water. Another major milestone was achieved. That was starting up the process compression facilities, which are required for CO2 injection. Siemens Energy team, I have to say, including the CEO and the execs, have been incredibly supportive of the project. This is a large, complex machine which basically started up first time. We've now started loading the first fills of pellets and chemicals and continue to start up the other unit operations. So next up are the centrifuges, and then after that is the calciner. And these are the two remaining unit operations before we export the CO2. We continue to optimize each of the units during startup, as we always do. And while that does cost us some time now, it will pay tremendous dividends going forward. Priorities are to learn for long-term capture efficiency and uptime. So overall, we expect to be circulating KOH this quarter and injecting CO2 in Q1.
Okay, thank you. And I had a couple questions around just return of capital as the follow-up. And so I think following the OxyChem sale, while I think investors definitely recognize the value in improving the balance sheet, some of the concerns that we heard was about the legacy liability. So I guess this will be the first time you'll have an opportunity to maybe address that and help people get comfortable around that. And then while I know that you can't knock out the preferreds until August 2029, is there an opportunity to opportunistically repurchase shares before then to help alleviate some of those concerns? I just want to give you an opportunity to address both of those. Thanks.
Okay. With respect to the return of capital, we definitely want to take out all that we can, the $6.5 billion of debt first. And then beyond that, we are going to opportunistically buy back shares. And it has to make sense. It's a value calculation for us to determine whether to do that or whether it's best to take down some more debt or put more into the business. But one thing with respect to the use of cash, I want to make very clear to everybody, and that is that we're not going to aggressively put lots of extra barrels into an oversupplied market. So when we're talking about the possibilities here on the call, I want you to understand that we definitely have plans to be very flexible in that. And I think Richard may have an opportunity later to share more on what that's going to look like. But we are going to stay within our means in terms of using the cash that we have, but not taking down too much cash off the balance sheet. We'll try to maintain about $3 to $4 billion on the balance sheet as we go forward. And the legacy liabilities with respect to OxyChem, the bulk of those liabilities are outside the operating areas that were purchased. And there's very little cash being spent or any necessary activities beyond what's already happening within those assets, operating assets that were bought. Everything else is outside. It made no sense for those liabilities to go. And what they're costing us is right now is somewhere in the neighborhood, of $20 million or so on an annual basis. The liability that's the largest, of course, is the Passaic. But that Passaic it's going to be spread over 20 to 30 years. So this is going to take a lot of time to develop that and to work that. And so this really has minimal impact on us to maintain these. It's really not material to what we do. And the repo, the Berkshire, you want to talk about the Berkshire, Sunil?
Sure. So Neil, like again, I mentioned in my prepared remarks, now that we've got a debt target below our goal of less than $15 billion. And as Vicki outlined, we're going to be opportunistic with respect to share repurchase. It's going to be driven by the macro conditions, where our stock price is trading, cash and balance sheet, because our ultimate goal is to start or resume the redemption of the preferred once we get to August 2029. So what you're likely to see is as we get towards August of 29, we're going to start building up cash on our balance sheet. So there is no formula as such in terms of share repurchase, but we're just going to be opportunistic, considering or keeping in mind that by August 2029, we want to build cash on balance sheet.
Thank you. And our next question today comes from Paul Cheng with Scotiabank. Please go ahead.
Thank you. Good morning. Sunil, can I just clarify that you in your 2026 CapEx, you're saying that you're going to redirect, say, $250 million from the LCV into the Gulf of America and Oman. So does that mean that LCV, we're not going to spend any money at all? And also that I think for Richard, can you talk about the $400 million that on the quick payback onshore project, what kind of production contribution we should expect for 2026? The second question is exploration. With your resource, seems like you are finding more ways to get resource from the onshore market. So does that mean that exploration will remain sort of like not the most important aspect for your program over the next several years? Thank you.
So, Paul, with respect to LCV CapEx for next year, we think it's going to be around $100 million as we roll off capital with the completion of Stratos.
Yeah, I'll pick up a bit of the scenarios with the potential $400 million that Sunil talked about. I mentioned in my remarks sort of a target initial plan of 55 to 60. And what that means is really, if you think about continuing activity this year, that would be up to that $400 million that Sunil talked about. So actually flat in terms of resources that we would go from this year into next year. In terms of what that makeup for next year might look like for EOR, it's actually it's light. It's about $100 million between EOR and unconventional EOR, and so it's fairly light next year. And it's actually pretty capital efficient as we look in the out years because we're not drilling wells, we're using CO2 in terms of the recovery. But also wanted to highlight we work scenarios below the $55 plan, and that's one of the advantages of the allocation of capital into the U.S. onshore. We have plans that go below $50 to be able to adjust to really carry Oxy in total in terms of cash flow to meet a break even and obviously cover our uses of cash. So we have that mapped out. We've done it in the past. That's why we wanted to go into some detail on the thought process of how we react to lower oil prices. Obviously, we like to work through efficiency first, but we do have that activity flexibility in our operations, especially in the U.S., to adjust in lower oil price scenarios.
And then in following up, then in Goa, we've already started deferring some exploration from next year into the following years. And in Oman, these are not really big E exploration. These are step-out wells very close to our existing facilities, which can be brought online incredibly quickly.
Thank you. And our next question today comes from James West at Melius Research. Please go ahead.
Hey, good afternoon, everyone. So, Vicki, maybe a bigger picture question for you. A lot of moving parts the last several years with Oxy, lots of changes in the portfolio. You've been busy is the key here. With the OxyChem sale, are we going into now a quieter period, maybe a harvesting type of a period?
Absolutely. And I'm thankful to be at this point finally. Yeah, we've gone through, there was a lot, as you said, going on, but this is where we wanted to be, and this is where we needed to be. So we've done everything that we set out to do with respect to being mostly a U.S. company and with very high quality, high margin assets, and assets that can sustain over the long term. And we think that our portfolio is so much differentiated from anybody else because we not only have the high return but high decline shale. It's complemented and will be complemented in the future by the conventional assets and conventional EOR along with unconventional EOR. And when we look at where our portfolio stands today, our production, our total development, 45% is conventional and 55% is unconventional. Going into the future, we have a ratio of looks like about of the total $16.5 billion that we have in resource, about 65% is unconventional, 35% conventional. But the beauty of the unconventional is what Richard talked about, and that is the fact that in the unconventional, we're going to be able to use CO2 for enhanced oil recovery in the unconventional. It's going to recover, we believe, up to the same amount as primary production. So we'll get 100% of what we got before. So we're doubling our total recovery from the unconventional. So that'll be actually low decline as well over time. So we think that versus a pure shale player or versus those that have assets that are difficult to manage internationally and in foreign countries, we think that we're much better positioned with this portfolio. So yes, we're done with anything that's any big acquisitions or anything like that.
Great. Thanks, Vicki.
Thank you.
And our next question today comes from Matt Portillo at TPH. Please go ahead.
Good afternoon. Maybe just a question to start out on the DJ. You highlighted in Q3 strong well performance drove upside to your production figures. I was curious if you could just maybe comment on in the Rockies if you've changed anything on the completion or spacing design or what's really driving the outperformance there.
Yeah, thanks. A big part of that beat, really the last couple of quarters, has been our base production. And so, a lot of work we've talked about in the past we've been doing around artificial lift, even using some analytics to improve our efficiency on that. So that was the biggest part of it. We have had better new well performance as well. I wouldn't call it major changes. We just continue to tweak sort of our subsurface designs and, our flow back. The base actually, the production operations that support the base also help our new well production. And so a lot of that new well beat is just better uptime on some of our processing facilities.
Great. And then maybe just a follow-up on the inventory. I was wondering if you might be able to comment on your views around your DJ inventory and how you might be able to flex capital in kind of a lower commodity price environment, just thinking through kind of the remaining locations left and obviously some of the upside that you've highlighted here in the Permian, how you can flex capital between those two basins.
Yeah, that's great. Yeah, we've been largely working in the DJ around an optimized activity set. We've had a couple of rigs and one frac core. And so that's been a big piece of it, continuing to show efficiencies, like I said, on well cost earlier. I think in the Rockies, as we look to the future, excited about the Powder River Basin. We continue to make progress there. We sort of have been working similar to the way I've described the Midland Basin, where we first were sort of proving out the productivity of the wells, really in the 23-24 timeframe. And then in 25, we've had a partial rig year where we flexed a rig up to the Powder River Basin. We've had, really drilling record after drilling record up there. We've improved about more than 25% versus last year in terms of drilling performance. So that was a big part of it. And so now really, as we look to 26 and beyond, we have that opportunity to flex from the Rockies to the Powder River Basin. And so, again, don't really see a increase in capital, just more optimization in terms of that portfolio for the Rockies, with that.
Thank you. And our next question today comes from Neal Dingmann at William Blair. Please go ahead.
Yeah, good afternoon, guys. I think my question is just on the low Permian well cost that you all showed for Richard. Is the larger projects contribute to that, or what was the main driver of that exceptionally low cost?
Yeah, great question. We've been on this mission the last couple of years to really relook at both the operational efficiency of our operations and, working, like I mentioned earlier, around our contracts and service contracts. And so it's really been a bit of both. I'd say the scale in the Midland Basin certainly helped. We were able to combine really the best of the best from Oxy and our legacy Crown Rock team and really just worked on, that piece of it. But the scale certainly helped. So I do agree with that. But from an efficiency, from a contract standpoint, I think we were also entering a period where we made sure we were getting, the right contracts for the right type of work. And so we've done a lot of work on that. We're fairly short right now in terms of contract term. And so we're working hard with our partners there to kind of think about how it looks going into 2026 and making sure we got, those two pieces put together correctly.
Great point. And then just to follow up, Richard, you talked a lot on the unconventional EUR today and the amount of possible recoveries there. I'm curious, what type of returns? I assume the returns around some of that incremental upside would be very positive, I would think, correct?
Yeah, we highlighted 25 to 35% kind of where we're at today. And so, if we're able to increase the uplift like we're talking about, those are only going to get better. So the goal obviously is to be competitive on our portfolio. And so the teams will be working on that. And that, again, that's the beauty of the portfolio that we have. It's not so much the expansion, but it's the competition.
Some hot news on the government shutdown. That is why the speculative markets and the tech is going up. Stand by for more news.
Thank
We will
you.
cover
and
this.
Our final question today is coming from Leo Mariani with Roth. Please go ahead.
Yeah, hi, good morning. Really appreciate all the details on 26. You certainly talked about the range of capital, $6.3 to $6.7 billion. Very helpful. Can you give us just some high-level indications of what would you kind of expect production to do in that range? Is that kind of a maintenance range for production, maybe at the lower end, and maybe you see a modest amount of growth at the high end? What can you kind of tell us about kind of associated production?
So in terms of production, you would be looking something close to flat to potentially up to 2% growth.
Okay, that's very helpful. And I guess any specific areas that largely kind of unconventional that kind of provides the growth, for next year? Is that kind of the flex piece? Is really that $400 million, which I guess is mostly unconventional Permian?
That's right. So the growth will be largely driven by unconventional Permian.
Right. And as I mentioned, the flex down, we'll go after efficiency first to maintain activity, but in position to be able to cut activity as required based on the macro.
Thank you. And that concludes our question and answer session. I'd like to turn the conference back over to Vicki Hollub for any closing remarks.
Before we close, I want to express sincere appreciation to the entire OxyChem team for their steadfast commitment to safety and operational excellence. Their achievements have contributed significant value over the years, and we're confident that OxyChem will continue to thrive under new ownership. So thank you all for your questions and for joining our call today.
Thank you. Today's conference has now concluded, and we thank you all for attending today's presentation. You may now disconnect your lines and have a wonderful day.
There we go. That was the Occidental Petroleum earnings call. What do you think? Was it a good call? Was it a bad call? I think the guidance wasn't bad. They are on a good track, but the market didn't like. Once they started asking questions, they didn't like their update on their future. So that's quite interesting. I'm running a poll. We are running a poll in the chat. Listening to the earnings call, is Oxy a buy, hold, or sell? We've got a few votes. I will leave this on for a bit. We will quickly check up on the whole market. So let's have a look at what S&P is doing. S&P is slightly up. Nasdaq, crypto, no major move. Gold and silver going sideways. Well, what happened? We have update on the government shutdown, and look at this. Joby up. That is race. That is only 2.5% up today, but on the dip, we are about 5% up. Archer over 10% up from this dip, and as you can see, I've marked up this support 820, and we touched it perfectly twice today. So look at this. Next will be the resistance of $9. If we break through it, we can have a look. We can see some nice levels. We can see I moved this one. I remember I moved this one by accident. We can see I think $10 will be the next support, and then if we break through $10 and we have the momentum, we are looking at retesting the main and the biggest support, which was $14. We've never broken through the support of $14. Sorry, 14 here. 14, what was it, 1460 something, yeah. So we always broke just above $14, but we never broke through it fully, and we never broke the trend. So we might be at the beginning of the eVTOL rally I have been predicting. If we have some good news on the government shutdown, and that could definitely have impact on the eVTOL stocks. Why? Because because there's no progress with the FAA certification. The air traffic control is taking hits as well. The whole aerospace is taking hits. You heard it from Joby and Archer on the earnings call last week. By the way, great shows. Thank you very much for joining me. That the government shutdown is having impact on their certification progress and is delaying their certification movement. EHang, no big reaction to it. Horizon Aircraft has broken through the $2, and I can see Horizon Aircraft going all the way down to $1.50 again. Unless we have some massive news in the coming days, I would not be surprised if we get all the way down to $1.50 and bounce off it multiple times. This could be a great entry opportunity for me as an investor. EV Air Mobility, as just piggybacking on the upbeat sentiment on the eVTOL, on the whole eVTOL market, and beta is not doing much. Okay, so I will log out. I will end this show in 5 minutes. I will see if I can bring you any updates on the government shutdown progress, because apparently the Senate has agreed the bill to close or to end the government shutdown. This now needs to go to the White House. Once it's signed by the president, Donald Trump, boom, we are cooking on gas. So I will try to bring you some more updates. I'll try to cover this live if we have any live coverage. So I will end this event. The next one, if I'm not going live, the next one is just before the closing bell. I'll tune in. We're gonna talk about the closing bell. We're gonna talk about the updates on the government shutdown. I'll bring you some more insights, and then we will be looking at a new company on this channel, Microvision. What do Microvision do? Microvision are focused, or they are developing. I see an update from Cedar. Archer just tagged its monthly AWAP at $8.83. Can go higher if it can push through here. Yes, I agree. Let's have a look at Archer. but Microvision is a company developing and producing LiDAR, which is light radar. We'll talk about it later on the event. They have very good potential. The market of LiDAR is quite big, and the future is quite bright. So let's see if we get some updates from Microvision and if we have good guidance as well. So if I won't see you shortly with any updates, maybe when Donald Trump is speaking, or maybe if we have any more updates on the government shutdown. If I don't see you on there, I will see you on the next event, Microvision earnings, about 15-20 minutes before the closing bell. Thank you very much for joining me. It was very interesting. I love these earnings calls. I'm always learning. So let's close the poll. I'll quickly go through the chat with you. Who we've got in the... Sorry, what is the result? So listening to the earnings call is Occidental Petroleum. Is it a buy, hold, or sell? Buy 52%, undecided 24%, hold 18%, and sell 6%. Right, do we have any interesting insights or any questions? WTF says Veterans Day, United States, federal holiday, day off, congratulations, paying tribute to all the veterans, all the soldiers who served as well from our channel. Cedar says Oxy looks like it wants to fill the gap up today, maybe back to 41.80. Well, let's have a look. I think you are fairly bang on with your chart analysis. So you almost hit it to the cent. But let's see what it does later. Another all-time high for CRAK crack today. All refiners ETF. Very interesting insight. Ganja only have 15 shares. Should I buy more? What have I missed? See, hitting it $44 to $45. Well, hopefully the earnings call you found it interesting and you've learned a lot. Abby is here. Thank you for joining. Smash the like button. Yes, smash the like button on your way in. Was hard not to yawn. Well, I've had very short sleep last night. So yeah, I'm peaking. I'm always peaking after work. I come home from work, I wind down, I sit down, I have a nap, and now it's just hit me to the trough, not to the peak. I'm peaking at work and I'm peaking on the evening show, but it hit just the trough, the bottom of the valley of my awakeness. So yeah, it was a bit difficult. Thank you. 1 minute chart hit 42.6. Archer is moving up, yes, and it will be moving up if we have this good news. It will be moving up. We'll check the market shortly. Maybe Gevo and Oxy partnership in the future with CO2 storing. Yeah, I like it. That's interesting. Ganja, God bless you. Thank you. Cedar, heating oil outpacing crude oil in 2025. I think oil is ready to play catch up. Archer, yes, we'll look into that very shortly. Cedar says Oxy just tagged the AVWAP weekly at 41.65. Should see a bounce here if the bulls want to stay in control. Well, are they staying in control? You might be right again. Abby says he's undecided on the guidance. That's perfectly okay. Do it for yourself. I'm new to trading and have been looking at this ticker. I just came in, but would this be a good investment? Well, the guidance is not bad. We have Warren Buffett. He's the main investor. He's the main investor in this stock as well. I mean, I can't tell you buy, hold, or sell. You need to best off if you just joined, rewind to the beginning of the stream to the event, beginning of the event, and you can listen to the guidance again. I'm giving you a quick breakdown of the company. I'm giving you a quick review of the fundamentals, and you can then listen to the guidance. It wasn't a long call. It was about an hour and what was it? Hour and it wasn't even an hour, was it? Yeah, we have been live for 1 hour 20 minutes, so it was just about an hour. So I do recommend you rewind back and listen to it again, and you can hear the guidance. You can make your own decision. Do it for yourself. If you are new to this sector, if you are new to trading, I definitely strongly recommend to you subscribe to this channel because we are covering many earnings this season. We are bringing you new emerging markets. We are bringing you a lot of great investment opportunities. Cedar says Archer just tagged its monthly AVWAP at $8.83. Can go higher if it can push through there. Yes, I agree. Aria, your opinion? I've just, yeah, I don't have an, I would say moderate buy to me, but I'm currently not investing in this, so I can't give you any advice. Vaz, thank you for your service, and to all the veterans. Yes, thank you, Zach. And Ninja Cowboy is here. Yes, sir. Right, let's have a look at the markets. I'm not gonna go live with my eVTOL show today because I've got quite busy day, because I've got another event after or around the market closing bell. Joby, slight cool down of the upside. What else we've got there? Archer, interesting. I don't think we're gonna touch that $9. Let me zoom out. This is not a financial advice. This is just my insights, okay? My investment strategies. I'm currently mostly out of the eVTOL market for my personal reasons. Not that I wouldn't believe the companies, not that I wouldn't be convinced or bullish, or I would be extremely bearish. That's just because I had to liquidate most of my portfolio and use the means somewhere else. However, I have been predicting a big rally in the coming months on the whole eVTOL market. I don't think we are not there yet. We are not there yet, but we are very close. Next week, Dubai Air Show. That could be a massive catalyst. Updates, regulation updates, news, new product presentation. Most of the eVTOL manufacturers should be present in there. Joby confirmed demo flights. EHang should be doing demo flights. Beta Technology should be doing demo flights. We are still waiting for Archer to confirm their demo flights. I said demo before. Demo flights. Always partnerships, new customers, you name it. I think that will be big catalyst for the whole eVTOL market. So we might see one last push down, and if the Dubai Air Show goes well, we could see a good push up and a good rally start. I'm not saying that'll be the definite rally, but I think we can have a look at the start of the rally. Vertical aerospace going up slightly. I noticed this on the chart. We may have a new trend, so let me just zoom out. We may have a new trend line forming. If I zoom into this low of $3.93 or whatever that was, we may have a nice new trend line forming. So let me leave this here. I always leave it on there for a few days, or I leave it there full stop, and then we can come back to it and you can see how accurate my predictions were, because I might not be as academical on the chart as Sensei is, but I know the fundamentals as well, and I'm trying to take the best out of the two worlds. Obviously, I'm not on Sensei's level, but also Sensei doesn't have the vast knowledge. So I'm trying to bring you the best out of both worlds in my predictions. But again, this is more for fun. This is not a financial advice. I'll be using this for my own investments and my own investing strategies, which I like to share with you sometimes, but this is not a financial advice. What else we've got here? EHang, I can see your comments. I will come back to it shortly. EHang currently going sideways. Horizon Aircraft, as already hinted, we will break through, as more than likely we will break through this $2 support, and we are looking at laddering down all the way to $1.50. Unless we have some good news in the coming days. Eve Air Mobility, that will be probably going sideways for a while, and Beta Technologies not recovered from yesterday's crash fully. Oh, no, crash, slight sell-off. Okay, what is the S&P doing? Slightly holding up. Nasdaq still slightly below sideways, slightly down. Bitcoin, XRP, Ethereum going slightly down. That's very interesting. Gold pushing up, and silver up as well. Very, very interesting. So let's have a look at the chart, and I will wrap it up because I need to get ready for either Donald Trump speaking, if he is, or the Microvision earnings. Zach, CSS. The key difference between VWAP volume weighted average price and anchored AVWAP anchored volume weighted average price is the starting point. I hold no position in Oxy or Archer, just keeping an eye on the markets. I love it. Thank you very much for joining. This is why I love this channel and this community, because you always join. You all join, and we share our opinions, our positions, and we are learning from each other. Vaz, check out that chart from All Star Charts I sent you on Discord. Interesting look into eVTOL market. Yes, I had a look. I need a bit of time just to zoom in and digest the data, but thank you for that. I love it. That's great. I'll come back to you on this. I might use it later. Thank you for that. Okay. That's it. It's time to wrap it up. I will see you. If I won't see you sooner, I will see you in about 1.5 hours on the closing bell, and then Microvision earnings. And we might have discovered very interesting. Oh, we haven't discovered, but we might have brought you tonight. We'll have how to say it correctly grammatically. We may bring you, just use simple English. One of my colleagues told me when I started my my office job, just said simple English sometimes helps. So you never know. Tonight we might discover a new interesting investment opportunity. That's it from me. Take care of yourselves and each other.